the Concord Coalition. As Professor Gravy said, during each discussion, you can submit questions through the Q&A box on your screen. Thank you for joining us for this webinar, Fiscal, Monetary, and Economic Challenges of the Post-Pandemic Economy. And now I'll hand the conversation over to Bob Bixby.
Thank you very much, Shannon, and welcome everybody. And thanks once again to the Rudman Center for co-hosting an event with the Concord Coalition. And of course, Warren B. Rudman was the founding co-chair along with Paul Songas and Pete Peterson of the Concord Coalition. Good morning, Director Swagel.
Hello. Hi, hey Bob. Thank you so much for including me, and thanks to the University of New Hampshire and the Franklin Pierce School of Law. Thank you so much.
Phil is the director of the Congressional Budget Office, whose mission it is to provide objective and nonpartisan information to the Congress to assist with its budgeting. And boy, I can't think of a more challenging time to do that. Phil, in the past year, making budget and economic projections has been complicated. It's already complicated enough by the usual variables, but now CBO has had to worry about things like social distancing and the uptake rate on vaccines, and having to make, and because those things have large economic effects, having to make projections about those things. So I can't think of a more difficult time to do that. You know, CBO's most well-known product is the Budget and Economic Baseline that just came out last week, and it provides 10-year projections, not predictions, just projections. And you know, generally, as I looked at it and looked at the commentary about it, there was a sense that these were more optimistic projections than the agency had given late last year. It's not, however, a rosy scenario by any sense. It looks like there are still some challenges ahead, and there's a certain touch and go quality to the baseline. By what I mean is that the effects of the pandemic will fade and the economy will grow you know, fairly strongly in the next few years, and the budget deficits, which have been very high, will begin to come down. And then around 2025 or so, it begins to go back up again. That is, the deficits begin to grow again, and the economy begins to slow, which was kind of an interesting phenomenon. So with that as background, I'll turn it over to you, Phil, for just some opening comments about the challenges ahead for policymakers.
No, great, Bob. Thanks very much. And you know, I should also just add that these challenges are familiar, you know, to the founders of the coalition, right? Senators Rudman, Senator Songas, and Secretary Peterson, Pete Peterson. So you know, these are longstanding challenges that we still face, and as you said, made all the more difficult by the situation with the pandemic. So let me just say a few minutes on the budget update that we released last Thursday. The deficit is projected this year to be $2.3 trillion. That's 10.3% of GDP. Now that's down from 14.9% in 2020. So it's a large deficit, a wide deficit, both in dollars and percent of GDP, but it's coming down from last year. And of course, the impact of the pandemic-related legislation is notable. And one thing we should mention is that these numbers, everything I'll discuss, is under current law. So we have a series of cost estimates posted on the CBO website that go through the various reconciliation proposals that have been considered by committees in the House of Representatives, but those are not included in our budget update. And as you said, an important element of the fiscal outlook that we just released, as compared to the previous one last year, is that the economics is stronger than what we had in September. And it means that in 2021, the cost of the recently enacted legislation, the legislation enacted last year, is partly offset by the effects of a stronger economy. It means improved revenues from what we saw in September. It affects the fiscal outlook in years beyond 2021 as well. We have a mix of stronger activity, there's higher inflation, again, reflecting stronger activity, and higher interest rates, reflecting both stronger activity and a higher debt that boosts both revenues and outlays, but revenues more than outlays And so that accounts for the improvement in the fiscal outlook. So this is not saying that spending pays for itself, but this better economy and the fiscal action taken in 2020 is certainly part of that. So we see real GDP returning to its pre-pandemic level by the middle of this year, and then reaching and surpassing its potential in early 2025. Now, the labor market lags as usual. The unemployment rate declines gradually through 2026. The number of unemployed people returns to its pre-pandemic level in 2024. So that's, I mean, it's of course, it's a tough situation, and the effects of the pandemic and the recession associated with it are skewed with the people who are most vulnerable, especially being harmed. But you know, the good news, such as it is that the economy is doing better than we expected, at least in September. You know, the challenge is that the fiscal situation remains daunting. And it was daunting before the pandemic, and yet it's yet more daunting because of the pandemic. And the challenge is that even with a better economy and with interest rates remaining low, deficits widen again in relation to GDP later in the budget window. So we get past the pandemic, I know we're all looking forward to that, and the deficit is still wide and the fiscal challenge is mounting. And you know, I have to use the word even again, even with low interest rates, the wide primary deficit means that the debt mounts by the end of the budget window, right? So the interest rate is lower than the growth rate, right? Nominal interest rate lower than the nominal growth rate, and that helps, but not enough to prevent a rising debt by the end of the budget window. It could be, of course, that rates remain lower than we project. That would help the fiscal outlook, just as higher rates would make it more daunting. And of course, a key challenge is that it could be that interest rates remain low or lower than we project because growth remains slower. And so that in some sense would be you know, really a tough situation with a growth slowdown affecting the fiscal outlook. And so that's you know, that is the challenge, that even with low rates, even seeing us getting past the pandemic over the next several years, the underlying fiscal situation has large primary deficits that outweigh the positives of low interest rates and drive a rising debt trajectory. And so the debt is projected to equal 102% by the end of this fiscal year, rising to 107% by 2031, and that's the highest in the nation's history. By the end of this year, by the end of 2021, rising to 107% by the end of 2031. It's the highest in the nation's history. And looking out further, the debt is on track to exceed 200% of GDP in 30 years. And again, that's under current law. That doesn't include any legislation being discussed now. Now, there is time to address our fiscal challenges, and fiscal policy could continue to be used as a tool to address the challenges facing the nation if the Congress chose to do so. The fiscal challenge is not far. It's not over the horizon. It's within sight, and it presents a challenge for us as a nation. And that is, and so that's the challenge. We have the immediate challenge posed by the pandemic and the terrible effects it's had on so many people, and then the longer term fiscal challenge as well. So why don't I stop there, and thank you again for having me participate in the program.
Well, thank you for that overview. And I want to get into some of the factors that you mentioned and discuss them a little bit more. It is, you know, kind of unique. I mean, it really does strike me that when we looked at these things before, we were looking at recessions caused by economic factors, mismatch between supply and demand, that sort of simple thing. Whereas here, it's really, you have to look at the healthcare indicators as economic indicators because they're really driving what happens. Some of the variables that seem really important to the budget, and this was true pre-pandemic and will be post-pandemic, are programmatically healthcare costs, and also on the economic front, interest costs and inflation, and something called the output gap. So, and right now we're really focused. I mean, everybody's focused on the economic factors because that's really what's front and center right now. So let's talk about interest rates for a minute, because that's a factor that surprised us, all of us, I think, really, over the past several years, is the persistence of very low interest rates. And of course, that helps when you're doing heavy borrowing. It's good to have low interest rates. Is there a risk of taking on so much debt and then having it roll over at much higher interest rates that it could, servicing the debt could get much more expensive over the years? Or so I guess it's sort of a two-part question. What is CBO's view of the factors that have led to continuing low interest rates and the chances that they'll persist?
Oh, no, very good. Yeah, it's a key factor as we look at the fiscal outlook. And we have a super macro team and an analyst who's really an expert in thinking about the factors behind interest rates, who's written a couple of working papers. So if you go to our website, search for his Ed Gamber, and he's got a couple of recent working papers that go through these factors. And we look at that. We look at it carefully, that interest rates have remained lower for longer than was projected by the agency over the past several years. And market participants have made the same mistakes. And one of the working papers that I mentioned goes through and shows that the CBO forecast on interest rates had the same characteristics as both market participants, so the interest rates implied by bond markets and by the forecasts of other professionals. And so in a sense, there's many reasons for low rates, right? Monetary policy obviously is one of them, holding down the short end of the yield curve and then affecting the long end as well through quantitative easing. There's global factors, right? As former Fed Chairman Ben Bernanke has talked about with the global savings glut, there's demographic factors, and then there's just the behavior of market participants looking for safety, and the safety of U.S. Treasury securities, the safest asset in the world. So that has affected interest rates, and we've adjusted, right? I mean, our interest rate forecast has come down, and interest rates stay lower for longer than CBO has seen in the past. Now, on the other hand, as you said, the rising debt trajectory does mean that interest rates are set to rise over time. Now, of course, there could be other events that happen, and that's one of the papers that I mentioned goes through and shows there's been a series of shocks, in a sense, over time that have all gone in the same direction, lowering interest rates. I think a key challenge is looking ahead as the economy improves. Will monetary policy work harder? As the economy improves and interest rates naturally start to rise, would monetary policy work yet harder to keep interest rates down, even as the economy improves? This sort of not a traditional approach of monetary policy. So that's a key risk, and the carrying cost of the debt will rise as interest rates start to rise. And that's definitely a key risk for the fiscal outlook.
And what just briefly is meant by the output gap? I mean, I've been doing this for a long time, and I mean it's a term that has been much used recently. Yeah,
no, that's right, and there's a sense in which having attention to the work we do is welcome, and we welcome comments and constructive criticism. We pay attention to all criticism, but we welcome the constructive criticism. And it's something that we look at is the output gap is the gap between the current state of the economy, whether on an output on activity, GDP, or you could look at gaps on the employment side, and we look at both of those. So how far away are we as an economy away from our sustainable maximum level and that would be potential GDP. And just to note that the maximum is not like a hard ceiling. It's not like we go $1 above potential output and something just terrible happens. Interest rates zoom off or inflation zooms off. It's not like that. It's being above potential leads to other things, but those other things happen over time. And I'll talk about that in a second. But let me just say, so where were we at the end of the end of 2020? So, at the end of the last quarter, we saw an output gap of about 3%. And that declines in our projection, again, under current law, to 1.3% by the end of 2021. So the output gap for calendar year 2021 is about $420 billion in nominal terms. So that's in some sense the part of the economy that is missing. I mean, it's I think we all understand why it's missing. About half of that, about 200 billion, actually it's about $200 billion per quarter. So actually even more than half of that is services that are operating at a reduced capacity. So purchases of goods are running above trend. And purchases of services are below trend. And I think we all understand that. Like, there's lots of people who probably would like to travel, would like to go to mass events, right? I'd love to be up there in New Hampshire doing this in person. I think many of us would, and we can't for reasons we all understand. So part of the gap in the economy now relates to the virus. It's not insufficient incomes or insufficient demand or desire. It's on the supply side. And I think there's welcome progress with vaccination that will go a long way toward addressing that gap.
Let me switch from the economic to the budget number, the programmatic part of the budget. It remains true that the fastest growing part of the budget is the so-called mandatory spending programs, not controlled by the annual appropriations process. And among those, clearly healthcare costs seem to be the dominant factor going forward, and really have been. And there are two reasons. I mean, there's the aging of the population, more people qualifying for benefits, but there's also the cost per capita of providing the benefits, which tends to grow and has the oddly named excess cost growth. Some of these terms are really kind of interesting. Mm-hmm. Excess cost growth, well, what does that mean? But anyway, so in CBO's projections, healthcare costs seem to have a dominant role. So what is the, what work is CBO doing in that field to look at healthcare costs, particularly that excess cost growth? Because there's not much you can do about the demographics. Us baby boomers are here, and we're qualifying. So.
No, that's right. It's something that becomes especially important as we look at the latter part of the budget window, the 10-year budget window, where the deficits start widening again, and the debt to GDP level starts rising again. And as you said, it's driven by entitlements, by retirement programs, Social Security, and by the major health programs. And CBO has a super team that works on healthcare, both on the cost estimation side, looking at legislation, and then on the research and analysis side, including, I think, the world's top modeling team looking at health insurance. And so we've done a series of products over the past year looking at a variety of topics on in the health space. So one is our annual report on insurance, so insurance coverage, and that looked at the effect of the pandemic on insurance. And it's in some sense, it's a mixed situation. It's like bad news, but not quite as bad as might have been expected, right? So the pandemic threw millions of people out of work. Health insurance in the U.S. largely is tied to people's work. It's a mix of government provided programs, and then employer sponsored insurance, and then others, other things, including the insurance programs through the health exchanges of the Affordable Care Act. And so millions of people lost their employer sponsored insurance, health insurance through their work. The rest of the system picked up a huge amount of that, right? So there's a huge influx into Medicaid, and a pretty big influx into the exchanges, the health insurance offered on exchanges established by the Affordable Care Act. And the net of that was about 1 million. So 1 million people lost health insurance as a result of the pandemic, which is a huge number. It's immense suffering. On the other hand, the system worked, right? It's much lower than I think people might have expected at the beginning of the year. It's much lower than the loss in employer-sponsored insurance, reflecting the changes in our health insurance system and the sort of the different pieces of it. So that's one piece. We've looked at expansions of coverage. We have a couple of excellent reports. One looks at single payer health insurance. And again, the CBO doesn't put out proposals of our own, so we're analyzing proposals looking at single payer. We have a really nice report that says that essentially addresses the question, what would be needed to achieve universal coverage? And it looks at the role of mandatory enrollment, of which single payer is one, one way of doing that. There's others, and that's in that report. And then there's really a nice report that looks at who was uninsured in 2019 before the pandemic. So at the end of a decade-long upswing in the labor market, in which the rising prosperity of our nation had really broadened out, even to the bottom of the distribution, was seeing very welcome gains in wages and in incomes through, again, at the bottom throughout the distribution, who was still uninsured. And I think that provides a roadmap for policymakers to think about what other health policies they might consider. So that is sort of the nature of what we do in healthcare. I know I'm going a bit long here, but let me just circle back to your question, which is on excess cost growth, the term of art you mentioned. And that is something that, of course, we are looking at as well. And that's, that those are difficult decisions. How do we, how do policymakers consider these trade-offs between, the natural desire for improved technology, improved access for healthcare, and the resulting cost consequences? And it's something we're looking at as well.
Well, I'm going to transition in a second here to some questions from our viewers, but there's one that I get a lot, and I want to get in. So since I get this question a lot, I'm going to ask you and see if I can steal your answer from when I get it next. And people ask me, do deficits still matter? And why? So let me get your take on that.
No, of course, it's really the key question. And my guess is we went back to the words of the three founders, right? Senators Rudman, Tsongas, and Secretary Peterson. I bet we could look at a lot of what they've said, and it rings true today. And yes, absolutely, deficits matter, and we see that in 2020 and 2021, deficits widened considerably as policymakers took steps to address the challenges of the pandemic, both the health challenges, and there's a considerable amount of money for vaccinations. There's a huge amount of money, over $100 billion on education, and there's about 90 some odd billion dollars still to be spent from that on education, and then checks to American families, enhanced unemployment insurance, a huge array of legislative responses that widen the deficit, but address the key challenges facing the nation. So the deficit matters, and it mattered immensely in 2020 and 2021. So that's on one side, the near term. Over the long term, the deficit is a challenge, and the rising debt is a challenge. And it's both a challenge to our economic stability, that over time, the danger if debt rises unsustainably, that would pose a danger to our economic stability and our financial stability, to inflation, interest rates, and our growth. There's also a challenge of priorities, right? As net interest payments rise, both with rising interest rates and with the rising debt level, well, that crowds out other priorities, right? It poses a challenge for policymakers between various priorities, and that's the nature of the other challenge as well.
Well, I will take that answer, and and I think it's important. You raise an important thing. It really is. It's not an all-purpose answer, all-purpose question, because it really does matter what the context is. Mm-hmm. Deficits and debt are appropriated sometimes and for some purposes, and perhaps not as much for other times and other purposes. And it's a matter of trying to assess what the economics of the situation are. Speaking of this, kind of a follow-on from that question, and has CBO looked at all at the concept of modern monetary theory, MMT, at all, and what its relationship to deficits and inflation might be?
Yes, we have. I don't think we've published anything. Sort of not our role. Right, our role is to evaluate the legislation put forward by by the Congress, and provide input to them. So, but we've certainly looked at it. the challenge, I think, sort of everyone's aware of, is in the situation where things go off track. That if inflation is rising and so on, right? The idea that fiscal policy could be responsive in the time frame to address those challenges. I think that I'll use the word challenge again, right? That poses a challenge, and it's possible. I mean, we've seen fiscal policy in 2020 respond very quickly to the rising challenges of the pandemic. On the other hand, the economy slowed considerably in October and November, probably was flat in December, and we saw that in a weakening job market, including the effects of the virus wave over the winter that now seems to be receding. So fiscal policy was really fast in 2020, but then there's a lapse, and we saw the effects of that. And that's the challenge, I think, of the paradigm, is it flips fiscal policy and monetary policy, relying on fiscal policy to do the kind of adroit economic management that we really rely on the Fed and trust the Fed to do. And I think that would just be a challenge. I worry about when things go wrong. You have to think about, okay, if it works, great, but sort of trace through, well, if it goes wrong, what happens, and go through all of that. And I think that is where the paradigm faces really a lot of challenges.
Yeah, I think that would be a challenge. It's probably a mild term in terms of looking to Congress to make those difficult decisions. Let me ask a question that came in about the baseline, just to clarify. It does assume that current law, as you mentioned, and current law assumes that the individual tax cuts that were passed in 2017 will expire. So there is in effect sort of a bump in incoming revenues in the baseline, which would actually make the revenue numbers lower if those tax cuts were extended. Is that correct?
That is correct, and it's something you can see if you look at the tables in the baseline. You can see that revenue to GDP jumps up after the expiration of the individual parts of the 2017 Tax Act. That's right. And I should just say, we do an alternative fiscal scenario as well. We didn't put one out last year just because the press of other work, but I look forward to us doing that in the future. And we look at that again. We naturally look at expiring tax provisions. If those don't expire, a natural alternative would be to say, well, are there things on the spending side that are temporary in statute, but continue as an alternative. We're not putting forward our own proposals about what should or should not be permanent or temporary. We're just looking to provide Congress with information. So I anticipate us doing that work later in the year. I don't know exactly when, but sometime later in the year.
Well, among your many other talents, you must have ESP, because that was one of the questions that somebody asked me about, the possibility of a alternative scenario. We had another question which relates to the economy, and that is inflation. You would think under traditional terms, we would be thinking about the very high amount of debt is perhaps becoming inflationary, and yet inflation, like interest rates, have been relatively constrained over the years and is projected to do so. Inflation risks in CBO's view, what are the trade-offs and possibilities?
Yeah, absolutely. And inflation has remained below the Fed's target. Before the pandemic, inflation was below target, had been below target for quite a while, but was rising, right? And in some sense, that was, as Chairman Powell just said, that was not unwelcome, right? In a sense, the rising inflation we saw before the pandemic was welcome, because going back to the Fed's target after many years when inflation had been below, and that's just natural, right? That's what we'd expect when the economy is operating above potential, as we saw it before the pandemic, right? Again, it's not that inflation zooms up and interest rates zoom up. We see hours go up, participation goes up, wages go up, and those are the things that we saw before the pandemic. And I think many, if not most people, say those were welcome, right? And having rising wages throughout the distribution, especially at the bottom, that was a very welcome aspect of an economy operating at or above potential. As the economy remains below potential now with the pandemic, right, inflationary pressures are muted, right? There could be negative shocks, and we've seen, with the cold wave that's affecting much of the country, that is affecting energy prices with disruptions in natural gas and electricity and things like that. So there will be particular spikes in prices, and those could have knock-on effects. But we see inflation as remaining low while the economy recovers from the pandemic. The Fed's new operating framework looks to us to allow inflation to rise above the target for some time, and that's embedded in our projections. But inflationary expectations are still well anchored. So our projection does not have inflation rising far above the Fed's target, but instead going back. So it's certainly a risk, but it's not something that we see in our projection.
This is kind of a weedy question, but an interesting one. During the pandemic, there's been a real surge in savings. I mean, pent up consumption. I guess people are not able to spend. They're not able to take those vacations or socialize as much as they would, bars, restaurants, whatever. And so personal savings rate has really gone through the roof. So the question then is, as the economy reopens, will there be a surge of consumption? And did CBO factor that in looking at the short-term effect on the economy?
Yes, no, it's a great question. It's something we're looking at very carefully. And as you said in the introduction, right, we had a group that looked at social distancing. So we have a super virus team within the CBO that's looked at this, looked at the course of the pandemic and things like infection rates and hospitalizations, fatalities, and all of this is, of course, is important for the fiscal outlook and the economic outlook. And so as the virus situation abates, and we all hope it will. Of course, there's risks of further waves, especially with the new variants, and those are embedded in the possibility. Those are embedded in our forecast. We do expect spending to rise as the pandemic abates and as social distancing recedes, and some of that will happen quickly. And we've seen even the data this morning on retail sales. We saw a very rapid response of the legislation that the Congress enacted in December. It was signed by the president on December 27th, turned back on UI bonuses and sent out tax refund checks that were very quickly distributed by the Treasury Department. And we see that impacting spending already in January in the data that were just released this morning at 8:30. So we have some of that. And then as social distancing recedes, we have other spending as well, the service sector coming back. On the other hand, the effects of the pandemic are going to be with us for a while. And that's part of why it takes so long for us to get back to the situation we were before the pandemic in terms of the economy.
One of the things that it's an interesting question coming in from the audience is whether cryptocurrencies will become prevalent enough to become an effective force against inflationary monetary policies and deficit spending by government.
Yeah, it's a good question. It's something we're looking at. We have a super financial analysis division that looks at a variety of things in housing, financial markets, regulation, a lot of work on pensions, which are a really interesting financial issue. And one of the things that we're looking at is cryptocurrencies. And there's lots of interest in the Congress. So we haven't put anything out, but we're looking at that and looking at the effects on payment systems, and then in some sense the effect as an alternative asset. And what that means for the future of the dollar, Treasury securities, and so on. Right now it doesn't seem like it. The advent of cryptocurrencies poses a threat to the global role of the dollar and the important role of Treasury securities in the U.S. and global financial systems. But it's something we want to keep our eye on for sure.
I know one of the more popular products popular was the Concord Coalition. Is the budget options book, and I think that becomes even more challenging in this environment. But are there plans to add new options to that in the coming year?
Yeah, it's one of my favorite publications as well. And I know it's widely used. And this is the budget options. So we released that, the latest edition of that in December. So just 2 months ago. And I'm going to use my hands here to show it's a pretty thick volume that goes through a wide range of options, both on the spending side and on the revenue side. And none of these are policy recommendations, right? This is, if something's in there, it's not because the CBO thinks that Congress should pay attention to it. It's more likely because someone suggested it and asked us for analysis. And we said, great, we're going to provide the analysis to everyone. And we do this every 2 years. Now, the volume we put out 2 months ago, December 2020, allows you or anyone to construct their own fiscal adjustment, right? It has a mix, has some small things, has some really big things, changes to entitlements, to defense spending, to revenues. And so someone could construct their own large adjustment, and that's part of how it's used. Sometimes it's used for little things. Someone's looking for a small, pay for legislation, and it's certainly useful for that. At some point in the future, we'll do this again in 2 years, December 2022. We will come back and think bigger, right? Think about the long-term fiscal trajectory and look at that more carefully. That's our goal. Hopefully, we'll be past the pandemic by then, and can focus again on the big picture of the fiscal challenge.
Well, we've got time maybe for one more question. We've had it, so I'll sort of consolidate and simplify. There are a number of questions about the current COVID relief package making its way through Congress. And I know CBO doesn't make recommendations, doesn't weigh in on recommendations. You will have to come up with some sort of score. And I know you've been looking at the bills as they've been coming through the House. How complicated is that going to be? A very long process of scoring the reconciliation bill when it eventually comes out?
No, it's a great question. And it's a lot of what we do, right? The budget analysis division within CBO has analysts who cover every aspect of the federal budget. So on a line by line basis, we cover it. We have someone who's an expert in it. We have a tax analysis division that does the same thing on the revenue side. And we work very closely with our colleagues in the JCT, the Joint Committee on Taxation, which evaluates tax proposals from the Congress. So we have put up already a series of cost estimates for the provisions coming out of the committees in the House. And of course, the Congress will continue to work on that. And as they work on that, this further legislation, we will provide cost estimates as is useful to the Congress. Then we put it on our website. But already you can see the work that we've done. And I hope everyone can appreciate these cost estimates were posted over this past 3-day weekend. Right? As the federal government was closed, we were hard at work, right? Analyzing and estimating and putting up those cost estimates. And that's for the Congress, right? The Congress is working hard to address the challenges facing the nation. And that's our job, is to support them in that.
Director Phil Swagel of the Congressional Budget Office, thank you very much for being with us this morning. I know this is a very busy time for you. And now I'm going to turn things over to Scott Horsley of NPR News. Scott?
Thanks, Bob.
Bob, thanks very much. And I'm delighted to be joined this morning by Eric Rosengren, the president of the Federal Reserve Bank of Boston. I've got lots of questions, and I know our audience does as well. But first, President Rosengren, let me give the mic to you to make some opening comments.
Well, thank you very much, Scott. Thank you for joining me in this conversation. The outlook, I think, is fairly consistent with what Phil just laid out. So since last March, a lot of the economic forecasting in the near term has been tied to infection rates, hospitalizations, mortality, and vaccination rates. And unfortunately, in the near term, we're still at that point where the infection and vaccinations are really determining how quickly the economy snaps back. But as Phil highlighted, both monetary policy and fiscal policy are quite accommodative, and fiscal policy is likely to become more accommodative if some of the current proposals actually become enacted. So that's setting the economy up for a much stronger second half of this year. Now, I would start by highlighting the two things that the Federal Reserve focuses on are inflation and unemployment. And let's start with the labor market. We recently had an unemployment report where the unemployment rate did decline to 6.3%. But when you actually look more deeply in that report, it really showed a very disrupted labor market. I would emphasize the labor force participation rate is at 61.4%. It's roughly down 2% from a year ago. And if you start breaking it out by age cohorts and by gender, you see that the participation rate has really fallen, particularly for young people and for women of childbearing age, reflecting how the pandemic has affected their willingness or ability to be able to work as they try to take care of children and have other responsibilities. I would also highlight that the employment to population ratio is 3.6% lower than a year ago. So that's indicating that there are far fewer people working in the economy than what we were seeing prior to the pandemic. So just like there was the GDP gap that was discussed in the previous session, there's a labor market gap as well, and that gap is quite large. So that highlights that we have a lot more to do to try to get people back to work. And I would also emphasize not just people that are looking for jobs, but an awful lot of people remain part-time for economic reasons. So many of the areas where there's interaction with the public have been on part-time schedules, not because that's what the employee would prefer, but that's what the employer can afford. And that's been pretty consistently, it's come down quite a bit, but it's still quite high. Turning to the payroll employment, which is really a survey of employers, the last 2 months have been pretty restrained. We only created 49,000 jobs in January. That was a pretty weak number. And I would highlight, if you look at the components where social distancing really matters, think of leisure and hospitality, gambling and recreation and accommodation, restaurants and drinking places, all those areas actually posted declines in employment. So that just highlights that the pandemic is still dominating our labor market outcomes. And until we see more people vaccinated and the infection rate going down even more than it has to date, most people are going to be deterred from doing the same kind of spending patterns they otherwise would. Turning to inflation, all our major inflation indices are quite low right now. The CPI came out not so long ago. Both the total and core was at 1.4%. The PCE is low as well. So the Fed wants to have an inflation rate at 2%. We remain well below that. So one reason for a very accommodative monetary policy is our labor markets still have big gaps and the inflation rate is still too low. And then I'll just a brief comment on financial markets before turning over to questions. I would say that we have seen the long end of the market move up. If you look at the 10-year Treasury, it's substantially higher than it was 3 or 4 months ago. That is reflecting that I think financial markets are anticipating the economy will be picking up in the second half of the year and are anticipating that we're not going to continue to have long rates nearly as low as businesses and households pick up on their spending. Stock indices have risen from already fairly high levels, reflecting very low interest rates and the expansionary fiscal policy. They're roughly up 5% from the beginning of the year. So that's 5% from already fairly inflated levels. And we've seen commodity prices pick up as well, even before the cold snap and the problems that we've most recently seen. Energy prices are rising, but the price of a barrel of oil now is over $60. Just highlights a expectation that as the economy picks up, we're going to see some areas where prices are going to pick up as well. And commodities are a good place to look, and we're actually seeing that. So in summary, we're going to probably have a few more months where the pandemic is really going to be the dominant force, and that's particularly true in socially distant sectors of the economy. But I really do expect, as a large percentage of the population hopefully gets vaccinated by middle of the year, as we get to July, and people are able to start spending. There was some brief discussion on consumption and savings patterns. Many people do have a fair amount of savings as they've not been able to do I haven't been in a restaurant since last March, and I'm looking forward to doing that. I haven't been on an airplane since last March, and I'm looking forward to that as well. So I think I'm not alone in that. And I would expect in the second half of the year, as people feel that it's once again safe to do some of those activities, that we'll really see a pretty strong pickup in the economy. So why don't I stop there and turn it over to you for questions, Scott?
Well, thanks very much. I look forward to flying and eating out again myself. Just this morning, we got new consumer spending numbers from the Census Bureau, which were much better than a lot of forecasters had expected, showed a pickup in spending in January, goosed in part perhaps by those $600 relief checks that went out at the beginning of the month. Even bar and restaurant spending was up from December, although still down from a year ago. Contrast that with, as you say, that weaker than we would like to see payroll report for January. What are you hearing from your business contacts about sort of the short-term outlook? I mean, what do you anticipate just in the months to come? We all think when we get to herd immunity, we have a much brighter second half. But how about the remainder of the first half?
So in the remainder of the first half, I am expecting gradual improvement in the economy. As Phil highlighted, as people have gotten checks, they've started spending those checks. The checks went out primarily to people at low or moderate incomes, and those are the people most constrained right now in their ability to spend. High unemployment rate means that you cut back on your spending if you're unemployed, and having unemployment benefits extended and having a check come in the mail from the federal government relieves some of the stresses that many families were facing prior to the fiscal policy actions that were taken. So I do expect that some of those checks will be spent. Like the last time that we sent out checks, you do see a fair amount of spending when the checks first arrive, but there's also a fairly big increase in savings as well. In part, people paying off some of their debts, people being worried about how quickly they will come back to an employment situation. And as a result, they don't tend to spend all the money, even low and moderate income individuals. But I do expect that consumption over the next couple of months will be boosted by the current fiscal actions and potentially by additional fiscal actions. I would highlight that that's exactly why we're expecting the economy to grow strongly, is that the fiscal actions are giving the ability, particularly of many low and moderate income individuals, to be able to do purchases that in their absence they would not be able to do. And I would highlight the distributional effect of the pandemic. So there are sectors of the economy that are doing pretty well, but there are many sectors of the economy that are deeply stressed. If you walk around downtown Boston, it's really striking how many restaurants, bars, and those type of businesses have been shut down. Many of them are completely empty at this point. So you don't normally walk around Boston and see empty storefronts. You actually see a substantial number of empty storefronts right now. So hopefully that will change. And as people start spending and feeling safe, that should change. But I think it's still not going to happen as quickly as we would like. And it really gets at some of the stresses in the labor markets, because if we have more bankruptcies over the next few months and next couple of quarters, that makes it that much harder to re-employ people. So hopefully between the fiscal spending and the low interest rates, many businesses will be bridged to that point where we're back to a more normalized economy.
You mentioned inflation in your opening remarks. I saw an interesting tweet yesterday that economists who studied in the 70s and maybe early 80s are more concerned about inflation than economists who studied more recently. I'm not sure that holds for someone like Janet Yellen, but I'm old enough to remember when inflation was a real thing and when interest rates were in the double digits. And have we slain the inflation dragon, and can we afford to be just sanguine about any price increases that we might see this spring, either just from base effects or pent-up demand sort of being unleashed in the short term?
So I do expect the inflation numbers will improve as the year progresses. And one of the reasons is more of a statistical anomaly that you just alluded to, which is prices really declined during the spring when the pandemic first broke out. And if we look at kind of a 4-quarter moving average of inflation indices, As those numbers fall out of the average, we are going to see somewhat of a pickup in inflation. But I would be very surprised if we see a sustained inflation rate at 2% in the next year or two. With labor markets as disrupted as they have been, there normally is enough slack that I would expect that we'll still be undershooting our 2% inflation target. But there will be disruptions that are occurring. Commodity prices is a good example where those prices have gone up pretty quickly. So food and energy prices may go up as certain areas of the economy are facing some shortages. But what we really want for inflation is kind of the broad-based inflation rate to be at a sustained level of 2%. I don't think we're going to see that this year. I'd be surprised if we see it before the end of next year. So while inflation is something that any central banker should always be looking for, I do think that coming out of the last decade, it's hard to expect that it's going to be a significant problem in the near term. And I would expect both monetary and fiscal policy. As we get to full employment, I would assume that we will have less fiscal policy. And as we get to full employment and inflation does pick up, we won't have the same interest rates that we currently have. So policy doesn't seem stagnant when conditions change. It's very much path dependent. I don't expect inflation to be a problem, in part because I think that the Fed will take care of it if it becomes a problem.
Let me just interject an audience question here to kind of let you maybe lay out what the range that the Fed sees as appropriate. The question, which is intuitive for a lot of people, isn't low inflation a good thing? Obviously, too low inflation is not a good thing, but let me kind of let you speak to that a bit.
Yeah, so one reason we have an inflation rate of 2% is one, there are a lot of changes in a dynamic economy like the US economy, and actually measuring inflation depends on whether even the CPI versus the PCE, two measures of the same thing, can give you different answers at different points in time because relative prices changes differently and the indices are weighted differently. So 2% is roughly consistent with what we expect in an economy that's changing to be pretty much inflation's not a concern of most individuals or businesses. I would say another reason why we want a little bit of inflation gets to the very low interest rates. So when you think about what an interest rate component is, it's partly compensation for inflation, and then it's partly compensation for, instead of spending, you're actually saving money and you want to get a return for that. So it's a real return on the money that you invested. If inflation is literally at zero and the real interest rate is very low, it means interest rates during economic downturns are going to hit zero very regularly, which makes it much more difficult for monetary policy to react when we have economic downturns. So one reason why a little inflation is a good thing is it gives us the flexibility for monetary policy to react to negative shocks. And so for both of those reasons, it's important to have a little bit of inflation in the economy. And that's why the Fed has set a target of a 2% inflation rate. So we look on average over time to be at 2%. That's not a ceiling. So that means sometimes they're going to have observations a little bit above, sometimes observations a little bit below. I would say for the last 10 years, most of the observations have been below. So we don't want to continue to have that. And I think the experience coming out of the Great Recession was that we were too concerned about inflation. And as a result, labor markets healed very slowly. That's very costly to the people that are unemployed or not fully employed. And as a result, I think we want to make sure that we err on getting the labor markets healed as quickly as we possibly can.
Filling those empty storefronts you mentioned is going to take capital for a lot of small business people. There's lots of money available to folks who can tap into the capital markets. What is the financing situation for smaller businesses? And are there lessons that we can draw from the experience that the Boston Fed had with the Main Street lending program?
So one of the programs that we did do during the crisis was the Main Street lending program. And just for those people in the audience about what the Main Street lending program was, normally when we have a crisis like the financial crisis or we have the pandemic, central banks tend to do most of their activities by purchasing assets. And so when we purchase bonds, we lower the interest rate available for businesses to borrow at. but that only helps businesses that borrow in the bond market. That doesn't really help businesses that borrow in banking markets, and that's the small and medium-sized businesses. So one of the programs that we designed during the pandemic was to try to provide a program that provided low interest loans to more troubled businesses that might not otherwise get bank financing. And over between July and the end of the year, we did roughly $16.5 billion in loans to roughly 1,600 companies. That was really focused on making sure that we bridged some of those small and medium-sized businesses that might not have otherwise gotten financing from banks. I think the program was effective. We saw 70% of the lending actually occur in December. Unfortunately, the Treasury decided that we should end the program at the end of December. But I think it does highlight that central banks have to be more focused on helping small and medium-sized businesses, not just large businesses. So I think the next time we have a crisis, we should be thinking about how we make sure that we do get credit to small and medium-sized businesses. It's still very challenging. Most banks lend on collateral. So if you don't have collateral and just have a good idea, it's not that easy to get financing. And so I think it's important, particularly in economic downturns where many banks start pulling back and worry more about their own bank capital, that we think about ways to make sure that we do support those businesses that haven't been supported previously. So I think it's still going to be a little bit challenging for those businesses. If an individual doesn't have a good credit rating, and many credit ratings were hurt by the pandemic, and if individuals don't have collateral, it frequently is not that easy. A good example is restaurants. They're relatively high risk. Even in good times, many restaurants fail. So even though many people are going to probably demand restaurant services, it's not going to be that straightforward for the person to have sufficient capital to buy the equipment, to rent out the space, to hire people. So I think it'll take a little time for those kind of businesses to fully come back.
You talked about the slow labor market recovery after the last recession. The CBO, who we just heard from, has projected it'll be 2024 before we get all the jobs back that were lost last spring. I know the Biden administration wants to see that happen more quickly. What can be done to accelerate the recovery in the labor market and to prevent the long-term scarring of workers who are out of work for a long time?
Yeah, so scarring in the labor market is a real big issue. So people that face long duration unemployment find it very difficult to find new jobs, and that can become permanent in that people can drop out of the labor force as they get discouraged. I'm particularly worried about individuals, many women who dropped out of the labor force to take care of children. If we don't get public schools open, that may become a more permanent situation. I would say a positive aspect of the fiscal and monetary policy reaction is both have been much more forceful than during previous recessions. So in the Great Recession, monetary policy became quite accommodative. We had an initial fiscal stimulus, but it probably wasn't sufficient. And as a result of very low interest rates, fiscal policy is more effective than monetary policy at really boosting the economy. And what we're seeing this time is a much more coordinated approach, both in the last administration and the current administration, to thinking about how to use fiscal policy as a counter-cyclical policy. I think that's one reason why I'm pretty confident we will get labor markets to tighten up over the next 2 years. But even with that, it takes time. Just because those storefronts are empty, just because we have fiscal monetary policy, it doesn't immediately fill those restaurants with employees. So it's going to take probably a year and a half, and that's probably a good outcome. That's assuming the pandemic variants aren't more of a problem going forward, and that we're really able to solve a lot of the public health crisis that's really been holding the economy back.
As the administration pushes for more aggressive fiscal policy, we're hearing pushback from some in Congress, especially on the GOP side, about debt. We have a question from the audience about how big a concern debt should be when interest rates are low and the government's borrowing costs are currently low. Should we expect them to stay low? And how concerned should we be about the government's debt, and when should that be a concern?
My primary concern is with the labor market. So I think we should do what we need to do for fiscal and monetary policy to get people back to work. once we're at full employment, we shouldn't have the same kind of expansionary fiscal policy. So that means either taxes rise or government spending has to decrease in order to have much more of a balanced budget than what we've had over quite some time. So the appropriate policy is that fiscal policy should mitigate some of the problems of a deep recession caused by a public health crisis and maybe not a perfect public health response. But when you get to full employment, you shouldn't still be having that kind of fiscal stimulus. So that should, in part, we're going to have people working again. That is going to mean that a lot more people are going to be paying taxes. And in addition, we don't need to be spending on a lot of the programs that were designed to help mitigate those that have been so severely impacted by the pandemic. So we should be taking different fiscal policy as we get away from the pandemic, but we're not there yet. And as your previous question highlighted, I'm very worried about disruptions in capital and labor markets that if we don't address this aggressively, could become more persistent. So I think getting back to full employment quickly, and then that is the appropriate time to readjust both fiscal and monetary policy.
Another question from our audience is about the minimum wage. This pandemic has disproportionately affected workers at on the lower rungs of the income ladder. Do you think a higher minimum wage would slow the recovery, or do you have thoughts on that?
I think that one of the things that we've learned from the pandemic that we already knew, but have probably become much more obvious, is that essential workers are basically low and moderate income workers that are essential to the economy. And so we do need to have more equitable growth. In fact, I'm talking about that at Yale on Friday, about how we can think about a more equitable economy going forward. I think certainly one of those components is, do we have wage levels for essential workers that are appropriate so that they can actually live without government support, SNAP and other kinds of programs? And so I think that there probably is a role to be thinking about the minimum wage. There is no doubt that some small businesses do get affected potentially by a rise in minimum wage, but an awful lot of people are also helped, and that is particularly the kind of people that have been most impacted by the pandemic. So it's really a decision for Congress. It's not a monetary policy decision, but I think it's certainly something that's appropriate to think about, particularly if we want to make sure we have equitable growth in the economy going forward.
Another audience question. You've warned about the buildup of financial excesses, including excessive risk-taking. You talked about the sort of frothy levels in the equities markets right now. Are we at a point of excessive risk-taking there, especially from some of the maybe novice retail investors?
So there definitely is froth in some areas of the market. GameStop was an example of a lot of speculative fever occurring, but it was on an individual stock. And to be honest, that doesn't really concern me. The time to really worry about financial stability is when we're much closer to full employment. So one of the ways that monetary policy works is it causes asset prices to go up when interest rates are low. And so this is one of the natural ways that we get the economy back to full employment quickly. Now, what makes a lot of sense in the middle of a recession doesn't make as much sense when we're back to full employment. And so I guess my bigger concern is not so much the financial stability concerns right now, but the financial stability concerns I'm likely to have 2 years from now if we don't take back some of the accommodation of fiscal and monetary policy quick enough. I would say that there are underlying problems that do concern me. One example is money market funds. The Boston Fed also did an emergency lending program to the money market fund industry. Money market funds experienced runs in both this recession and the previous recession, requiring a government intervention by the Fed. I think it is time that we address the runs on money market funds so that we don't have to do that the next time we have a recession. I also think that the Treasury market was badly disrupted. As we just highlighted in the last session, there's a lot of Treasury debt that's going to be issued both this year and in coming years. And so it's important that that market is able to take the kind of volume that we see at economic turning points. And so I think there's a lot of work to be done about thinking about the infrastructure in our financial markets to make sure that they're as resilient as they need to be. But in terms of just the froth overall, a strong economy will make a big difference in the earnings for many businesses. One reason a price to earnings ratio is so elevated right now is earnings have been depressed by the pandemic. If we really get the rapid growth that most forecasters are expecting in the second half of the year, extending into next year, that should bring the PE ratios more in line just because the earnings will improve. But I do think if we don't take away some of the fiscal and monetary accommodation as we get to full employment, then we should be quite concerned about financial stability concerns. And I would say most recessions recently have been determined more by financial stability and less by inflation.
What changes have we seen in the economy or the workforce over the last 10 months or so that you think will outlive the pandemic?
So there have been many shifts. One is in the real estate market. Obviously, there are a lot more warehouses than there used to be as people have relied on Amazon and other carriers to provide a lot of the goods that we have continued to purchase through the pandemic. My office has been virtually closed since last March. We have some essential employees that are in the building, but to keep them safe, we've kept the building at very few employees in the building. We're continuing to do that probably into the fall. And I think a lot of, people are worried about taking mass transit. People are worried about getting on elevators. Until we really get everybody vaccinated, there's going to be a lot of empty office space. So I would say that there's a concern with real estate markets that we have to be thinking about. But I think on the positive side, we've learned that we can work from home much more easily than we ever thought possible. So if you had told me that we were going to run emergency lending programs and be able to conduct all the normal things that a central bank does in a virtual world, particularly a virtual world that went on for what's coming on to a year, I would have expected we would have encountered a lot more problems. We certainly did encounter some problems earlier. The technology, I think, has really improved. And I think it's much easier to have the kind of conversations we're having than it was last March. So I think there are some permanent changes that I think are positive. I think we'll probably spend a little bit less on business travel. We'll probably spend a little bit less going to conferences. Though I would say that there are a lot of advantages to going to conferences and meeting people in something other than a Zoom session. But my guess is that most businesses will be doing that at a more modest rate than we were doing before. So I think there are going to be structural changes in businesses. And I would say, though, that overall, many businesses have been quite dynamic, including those that have been really severely impacted. And a good example is restaurants. Takeout business has become much more prevalent. Some restaurants have found ways to actually thrive. Many businesses have not. But I think that there's a lot of innovation in the US economy, and coming out of a pandemic, we do take lessons that I think are important to learn.
Yeah, the economy has certainly proven its resilience in many ways. Well, thank you very much, President Rosengren, for sharing your thoughts on that. And I'll pass the mic over now to Tori Gorman, Policy Director for the Concord Coalition.
Good morning. Thank you, Scott. Appreciate the transition. Again, I'm Tori Gorman. I am Policy Director for the Concord Coalition. And today I am joined by Wendy Edelberg, who is the Director of the Hamilton Project and a Senior Fellow in Economic Studies at the Brookings Institution. Welcome, Wendy, and thank you for making time for us this morning. Okay.
Very happy to be here. I think you can hear me now.
Okay, so you let me start you off here. You recently wrote a paper analyzing the macroeconomic effects of two competing COVID relief packages: the $618 billion plan offered by 10 Senate Republicans, including notable Senate thought leaders like Bill Cassidy, Susan Collins, Mitt Romney, Rob Partman, but also the $1.9 billion American Rescue Plan proposed by the Biden administration. So I'm curious, what did your analysis show?
Yeah, I am very happy to show you what we found. I did this work with a colleague, Louise Shaner, And I am delighted to show you our estimates. All right, so in this first picture, let me just walk you through these lines. So this is our analysis of how the full $1.9 trillion Biden package would affect the economy. So the bottom line is CBO's current law projection. So this is the economic projection that was underlying the budgetary projections that Phil talked about in the first session. And so it includes the December package, but no additional fiscal support after the December package. The top dashed teal line is CBO's pre-pandemic economic projection. And then the purple line right below that is CBO's estimate of potential output, again, under current law, over the next few years. All right, now the all-important green line. That is our estimate of what the economy looks like if the full Biden package were passed. We estimate that the Biden package would result in real GDP exceeding the current law baseline by 3.6% at the end of 2021 and 2.1% at the end of 2022. In addition, you can see that real GDP rises above its pre-pandemic path for a time. So what that means is that some of the lost output as a result of the COVID-19 recession would be made up in future quarters. We estimate that there would be a positive output gap between real GDP and the maximum sustainable output of the economy, or potential output. That positive output gap would peak at 2.6% in the first quarter of 2022. So that positive output gap in our estimation would put upward pressure on inflation. We think that that upward pressure on inflation would be welcomed by the Federal Reserve. I think that's in line with the comments that we just heard in the previous session. But the temporary surge in economic activity would create a risk of how well the economy fares as it comes down on the other side of that peak. So you can see here that we've projected a soft landing after the peak in 2022 and early 2022, but there are risks associated with how the economy would fare as it slows. So we also analyzed the $618 billion Republican package. This is the one that you, I think, mentioned, Tori. Yes, excellent. So all the lines are the same, have the same logic as in the previous figure, but now the yellow line is what we think the economy would do under the Republican package. And what you can see is that it would raise, in our estimation, it would raise GDP by smaller amounts above the baseline than the Biden package. It would leave GDP about 0.6% below its pre-pandemic trajectory at the end of both 2021 and 2022. I'm reading too quickly. It would leave GDP about 0.8% below its pre-pandemic trajectory at the end of both 2021 and 2022, but a touch above CBO's estimate of potential GDP. And that, so you can see that the yellow line just comes just above the purple line. So let me talk a little bit about how we put these numbers together. So in a table, we're going to show you how we broke down the Biden package into different buckets. So what this shows you is just how we bucketed the $1.9 trillion in the Biden package. And so we thought about how the different components of the Biden package would affect the spending of the recipients. So in that first category, the $750 billion you see, so that's all money that we think would be spent essentially by state and local governments or by the federal government. And then you can go all the way down to the smallest package, or the smallest bucket that we put together, which is the $150 billion that we estimate would all essentially be aid to businesses. So that's how we organized the components of the package in order to do this analysis. So with that in mind, sorry to jump around, but if you now go to the third figure, you'll see how those different components were estimated to affect economic activity. And you can see that the largest effect stems from the $750 billion for COVID-19 containment and vaccination, aid to state and local governments, and increased federal spending. So that's that dark green region. If you sum up the entire the whole area of that dark green region, it's the largest of all of the regions. That's just because it's the largest size, but also because in terms of federal outlays, but also because of how we estimate that that those federal expenditures would result in spending in the economy. And then the smallest effect is that $150 billion that would be aid to businesses. And again, that's partly because of the small size of just those federal outlays, but also how we estimate that $150 billion of federal outlays would affect the economy. And we did a similar analysis for the Republican package. And you can again see that all of the different components are just estimated to have smaller effects. They have slightly faster effects per dollar. And that's partly because more of the money is targeted, a greater share of the money is targeted to agencies and households that we think are in dire financial straits. So I should stop there and take your questions. I'm happy to have a conversation.
Sure. I guess the one thing that stands out from me initially from this analysis is that the Biden plan appears to the primary objective is to run the economy hot for a period of time above real potential GDP for, I think, 7 to 8 quarters in your model. This obviously comes with some risks, which you briefly mentioned: inflation, for example, higher interest rates, and eventually a reversion to trend GDP. Given that we just heard from the president of the Boston Fed, I'm wondering what assumptions your model makes regarding the Fed's responses to those events.
Yeah, so let me just first step back and say that I think in terms of primary objectives, at least the way the Biden administration has described their primary objectives, they have a number of them beyond, I think, what they view as a good thing, which is running the economy hot for a time. I think their primary objective is the money that goes out the door to keep the pandemic under control, to distribute the vaccine, to reopen schools. I think they have a lot of objectives that they are trying to address in this package. But it's true that to think about how monetary policy would respond to these to this change in economic activity, that was a really critical part of our analysis. And in our estimation, the Fed would not try to so much lean against this economic activity. They would recognize that the pressure on inflation that they would see would be a temporary surge in inflation, and they would see through that. They would have a lot of, excellent economists projecting that inflation was going to come down quite quickly, I think, as the economy slows. So I don't expect that they would raise the interest rates in response to the increase in inflation. That would be a pop that they would welcome. But what they would have, I think, a challenging time doing, it's not beyond their abilities, but a challenging time doing, is managing the economy coming down on the other side. But roughly speaking, or broadly speaking, what our analysis rested on is that the Fed would welcome this increase in economic activity and not try to dampen aggregate demand in response.
So largely accommodative is what I hear you
largely
saying.
Largely accommodative, that's right.
Got it. So there are some of these potential risks with running the economy a little hot. Do you have any suggestions for policymakers on how to mitigate some of these longer term risks? For example, how to increase the probability of a soft landing, once real GDP returns to trend?
So I am absolutely worried about that soft landing. I am worried that with a surge in economic activity, businesses will have a difficult time teasing out how much of that surge in economic activity is just because everybody really loves their particular restaurant, and this is the time that they should expand into the empty space next door. This is the time to buy the extra pizza oven. I'm worried about people who have good, stable jobs being offered new jobs that have higher salaries, but it turns out that those new jobs are completely dependent on the surge in activity. And, so they leave their stable job, they take the new job, and then that new job disappears when the activity slows. So I am worried about all of those sorts of difficult transitions as the economy slows. I think that there are pretty straightforward ways to tweak the $1.9 trillion package to mitigate those risks. Slowing the money down, slowing the federal outlays down is just one obvious way to do it, so that it's more of a sustained boost to economic activity and less of a temporary surge that all takes place within a couple of quarters. Making more of the package dependent on how the economy is doing. There are ways to do that that are relatively straightforward, and keeping more money in reserve just in case the economy needs it and the recovery is not robust. So the absolute most urgent thing to do is enact a big package now. And I don't want to suggest anything that gets in the way of that outcome, but I do think that there are ways to adjust the package to mitigate these risks.
You were talking about slowing some of the rate of spending. Are there any particular categories within this broader package that in particular you're pointing at?
So, if policymakers want to come to me and let me offer these tweaks, one of the tweaks I would suggest is, rather than sending out the checks to households in one lump sum, spreading out that aid to households, that fiscal support to households, spreading that out more over time, I think would create more of a sustained recovery going forward, rather than what could end up being a big jolt in economic activity that our economy has a difficult time absorbing. I think some of the money that is being set aside to help state and local governments, on the one hand, I already think that money would be spent out by state and local governments slowly, but there are ways to ensure that state and local governments spend that slowly, for example, by tying more of that aid to infrastructure spending. So we know that investment in infrastructure is slow because it takes time to put projects in place. It then takes time to build them. It takes time for that to increase economic activity. And we know that we need to do more to invest in our public infrastructure. So tying more of that aid to state and local governments to infrastructure investment would be a way to slow down some of the economic effects. And also create, a more efficient economy, in the years ahead.
Got it. Understood. So let's switch gears for a moment and talk about methodology. Your analysis judges these plans in terms of their impact on the output gap. And Bob talked about this earlier with Phil Swagel, the output gap being the difference between actual and potential GDP. Question, is this the right approach to policy prescriptions when potential GDP itself is an estimate, which makes the output gap, even more uncertain? Would it be more appropriate, for example, and perhaps a better use of federal tax dollars to design a relief program from the bottom up, for example, rather than from the top down, one that targets relief to those who need it most? Or is that really just sort of a public policy pipe dream because the federal government really doesn't do a good job of targeting relief? It's sort of this tension between, we need to get the money out quickly, but if we're going to target it, we've got to slow it down and create all these filters. So what are your thoughts?
Yeah, I think basically everything you just said is right. But I think we need to do both. We need to both walk and chew gum. And it's my impression that when policymakers are putting together these packages, they are thinking about both goals, as well as, let me throw three goals in the mix. So one, we need a package that makes sure that we have all of the possible resources in place to fight the pandemic, distribute the vaccine, and contain the health crisis. So that's one huge priority. Another huge priority is making sure that we get relief to households and businesses that need that relief now, urgently. There are households that are under enormous financial pressure. There are businesses, particularly small businesses, that are at risk of failing and would remain viable and would be a source of labor demand and great economic activity post-pandemic if they could make it through this period. We know that some state and local governments are in dire financial straits, trying to, and not using the resources, not because they don't have the resources or they're afraid to use the resources to invest to get schools open. So we know that there are urgent needs right now. And we need a package that gets money out to those to those, to those people and those agencies and those businesses right now. And then the third goal is making sure that we have all the pieces in place for a robust recovery. The good news is that there's a lot of overlap in what provisions in how provisions would achieve those goals. So if we get the money out right now urgently to the people who are in dire financial straits, that will make those people better able to maintain their demand for goods and services over the next 4 quarters, let's say, and be, great contributors to economic activity and make sure that we have a robust recovery. So it turns out we can do all three and basically in one big package. But yes, those are all goals.
Mm-hmm. So, in looking at these two different packages, just from the graphs that you put forward, it kind of seems like the Republican package, sort of hits that little sweet spot. And again, talking about that, the Biden package, runs the economy hot for a little while. I've heard you make comments about how lawmakers need an insurance policy. So in evaluating these two approaches to COVID relief, can you talk a little bit about that comment? I found that very interesting.
It absolutely isn't. Doing more is an insurance policy. So I cannot overstate the uncertainty underlying all of our estimates. Thinking about what the economy would do over time without additional fiscal support, that's subject to enormous uncertainty. What the potential output of the economy is subject to enormous uncertainty. And thinking about how the potential output of the economy is actually contingent on what we do with regards to the pandemic, what we do with regards to economic activity. And then finally, it's incredibly uncertain how the economy will respond to additional fiscal support. We're talking about numbers that our models, we don't have a lot of good history to help guide us of how the economy responds to this level of this extent of fiscal support. Right. So given all that, it is hard to know whether or not so our estimates are that the Republican package just gets us above potential. If we're wrong on any one of those sources of our estimates, we could be significantly undershooting. And so the Biden package is an expensive and very large, but probably very effective insurance policy.
Got it. Understood. So I'm going to shift gears a little bit and take some questions from the audience. And this one, I'm going to give credit where credit is due. This is from Ben Ritz at the Progressive Policy Institute. And he says, you've written a lot about automatic stabilizers to ensure economic relief is not prematurely cut off before the economy is fully recovered. What about the flip side of that? Now, what do you think about using two-sided automatic stabilizers that also trigger some form of deficit reduction if relief spending ends up being more than is desirable or needed?
Well, I think that's at the crux of what automatic stabilizers do. We have, particularly in our tax system, very significant automatic stabilizers under current law, long before the pandemic. It's a critical part of our tax system. When a person's income is lower, they pay less in taxes. When a person's income is higher, they pay more in taxes. We don't simply tell each individual in the economy, this is how much you owe in taxes, regardless of how your income was last year. So our tax system automatically adjusts in a way that it turns out we think helps to stabilize the economy. So the fact that when you make more in your labor market income, you pay more in taxes means that there's basically a stabilizing influence on your income. The fact that a business pays more in sales taxes when their revenue is higher is a stabilizing influence on economic activity. So that the two-sided nature of automatic stabilizers is built into the system. But what I think is partly implicit in that question is also active fiscal policy helps to, can also be it's not an automatic stabilizer, it's an active stabilizer. And it's true that we do more often see policymakers in times when the economy is weak, putting in place fiscal support to boost the economy, relative to when times are strong, putting in place policies that dampen, economic growth and increase revenues and decrease spending.
That's exactly right. My concern is that when the economy starts doing well, what do? They cut taxes, and that's not, that's not the deficit reduction other side that we're looking for. So
Indeed.
Okay.
Yeah,
So,
I mean, it's a political economy question. The only part that I would say with my economist hat on is that given the low rate of interest rates right now, we're going to have a very challenging time if the rule of low interest rates remains. We're going to be putting more and more pressure on fiscal policy relative to monetary policy to be the game in town that helps to boost the economy when economic growth is weak. So I do think going forward, fiscal policymakers will see that they have more of a role to boost economic growth than they have to dampen economic growth. So that's just one thing to add to the mix of how complicated this is going to be.
absolutely. Another question. President Biden is expecting to pursue a second reconciliation bill later this year, focused on public investments like infrastructure, which we'd mentioned, climate change, which may not be fully offset. In your opinion, do you think that there will be the fiscal space necessary to debt finance these proposals, especially if President Biden succeeds in getting the entirety of his full American rescue plan?
So the challenge with forming the question that way, in thinking about fiscal space, is that I think that the question presupposes that financial markets can't necessarily accommodate a big temporary increase in borrowing, and so that there's some ceiling where financial markets are going to say, again, in response to a temporary increase in borrowing, that the spigot's closed. And it's the way I read, the past decades of the way financial markets have thought about, changes in federal borrowing by the U.S. government, is that there's something different between temporary increases in federal borrowing and the long-term trajectory.
Mm-hmm.
So I am more worried about what financial markets might think about the long-term trajectory of federal borrowing. Obviously, under current law, as Phil Swagel talked about, debt to GDP rises to just astronomical levels over the next 3 decades. It's my impression, looking at what's happening in financial markets, that they don't think that those projections under current law are credible, that they don't think that that's actually where federal borrowing is going to go over the next 3 decades.
Mm-hmm.
The day that they think, yes, federal borrowing is going to go off into the stratosphere and it's going to go up to 200% of debt to GDP, and it's going to rise without bound. The day they think that's credible, regardless of that day's level of federal borrowing, the day they think that path is credible is, I think, the day we have a real problem in our costs of borrowing. And so I wish we could come up with a different way, a different verbiage to think about the stresses of the trajectory, instead of thinking about the stresses of temporary increases in federal borrowing. I think what we've seen particularly over the past year, is that financial markets are, pretty nonplussed about temporary increases in federal borrowing, as long as the uses of that borrowing make sense to the folks who are doing the lending. So I think if there was which is to say, I think the punchline is, I think if policymakers were to come along and say, we would like to do a big temporary increase in federal borrowing and use the funds for this really useful purpose, it is my impression, given everything I've seen over recent decades, that financial markets would give that a big thumbs up.
Okay, so let me go rogue here for a second. Do
Okay.
you think that debt to GDP is still an accurate measure of our level of indebtedness? I know that there's been some recent thought from other notable economists, Summers and Furman and others, who are suggesting that debt to GDP, especially given low interest rates, is just not a good measure of how much fiscal space we have to do some of these, or to make these necessary investments. So do you still see debt to GDP as something informative, or should we be looking at other measures?
So it's one really informative measure.
Mhm.
I wouldn't throw it out. I think it's quite informative because in the sense that it tells us whether or not, like, we have a great capacity to tax ourselves. We're a really big economy, and as you can see by the size of our GDP, and so we have great capacity to finance this debt. That debt to GDP ratio tells us, whether it's rising over time without bound, tells us whether or not we're going to need to commit a greater and greater part of our economy to financing that debt. Interest payments as a share of GDP tells us much the same thing, but it incorporates interest rates in there. Then, of course, you have to put in what you think your projection is of interest rates. So these are all flawed measures. I don't think that a snapshot in time of debt to GDP is the most informative measure. I think it's a useful measure in looking over time and seeing whether or not it's rising or falling, and how policies are going to affect its trajectory.
Got it. I'm going to throw one last question in here, and I'm going to admit that this comes from one of my children, from sitting at the dining room table. She says, I think we need to do everything we can to fight this virus, but we entered this pandemic with a lot of government debt and big deficits. When will it be appropriate to start worrying about the deficit and debt again? And when can we actually do something about it without hurting the economic recovery?
I think you have excellent conversations around your dining room table.
She's a good girl.
So, I'm very much informed by CBO's projections, and what their projections are of interest rates, and what I see the projections of interest rates in financial markets. And I see that CBO basically is looking at these long-term pressures on spending and looking at revenues under current law. And at the end of this decade, we do indeed start to see debt to GDP start to rise, and then rise without bound. That suggests to me that over the next handful of years, we should be making some difficult decisions to change that long-term trajectory. But there's no shortage of ideas. One thing that I find frustrating is when I tell people about these long-term trends that are worrisome, and people say, but it's such a difficult challenge, we need better ideas. We need to explain the issues to policymakers. It's actually a very simple problem with pretty simple solutions. And we have no shortage of ideas here. We just need to make some difficult political choices over the next few years and decide what we care about as a society. These are difficult political issues, not difficult technical issues. So yeah, over the next few years, it would be really great if we made these difficult choices as a society.
Got it. Thank you. Thank you so much, Wendy, for being here today. I enjoyed this conversation so much. I really appreciate it, but I think we're running out of time. So I'd like to hand the floor and the mic over to the Dean of the Franklin Pierce School of Law, Dean Megan Carpenter, to close us out.
Thank you so much, Director Gorman. Thanks to Director Edelberg, President Rosengren, Director Swagel for lending their expertise today, and to skilled moderators, Director Bixby, Scott Horsley, and Director Gorman, and to Chase Hageman and John Graby for coordinating this event. It's clear that the fiscal, monetary, and economic challenges in a post-pandemic economy clearly depend on what happens during our pandemic economy. And clear-headed and strategic discussions like this help us navigate issues discussed today, from the pandemic dominating labor market and financial outcomes to signs of growth in commodity prices and financial markets. Creating a more equitable economy involving consideration of wage levels and the impact on small businesses. And also planning for changes in industries, finding ways to support that long-term innovation in the economy that was discussed today, from office space to hospitality and leisure. You know, it strikes me that these kinds of discussions are central to the legacy of Senator Warren Rudman, who was former co-chair of the Concord Coalition and the namesake of UNH Franklin Pierce's Rudman Center for Justice, Leadership, and Public Service. And one of the things that Senator Rudman said once, that he is direct and tends to answer questions directly. And I think he very much would have enjoyed the last couple of hours. Here at Franklin Pierce, we've long prided ourselves in being a center of this kind of debate and dialogue, conversations with straight talk and informing strategy. We can all solve problems, tough problems, when we work through them together thoughtfully. And this conversation today has been an exemplar of that. I think I took about 5 pages of notes myself. Thanks to all of you for joining us today and for everyone who participated in this critical dialogue.